Let's get started with a few things that I think are relevant here in this market. And I do think there's some significant changes going on in equity markets. And it feels like, for many reasons, this is the beginning of a bigger move. And main reason for this is, let's look at this chart. If seasonality matters by any means, in other words, looking at the prior 2 decades or 3 decades of data, and seeing how VIX, which measures the volatility of the market by looking at the implied volatility and put options in the S&P 500 over the next 30 days, essentially you can see that in the middle part of the year, we tend to see a pickup of volatility. So things tend to get a little dicey in the later parts of the year. It wouldn't be surprising if we have the same occurring or the same trend developing now. And you can see that there is a shaded green, or I should say a lighter green line that excludes the 2 parts of this, which would be the 2008 and 2020 periods, because those are big volatility events. So even when you exclude those, you still see seasonality actually picking up during the later parts of the year for volatility. So this is an important one because we're right at that inflection point where VIX starts to, or tends to increase in terms and we're coming up from very suppressed levels. If we show the next chart, as we can see here, we're looking at one of the most suppressed levels of volatility. So now what I'm calculating here, we're looking at the 2-year VIX. So instead of doing a 30-day implied volatility for the put options, we're looking at a 2-year or 24-month of that instrument. And you can see clearly, and we're looking at the SPY index, or I should say ETF, which is the S&P 500 ETF. And you can see clearly here, we've seen times when things also reach historical low levels in terms of volatility. And those are usually periods when you want to be hedging your portfolio because we're poised for a significant change in terms of risk and stress in the financial markets. And so this is essentially another way of measuring the risk for a downturn in the markets too. And I would point out that there are some credit spreads is starting to widen, which we haven't seen in a while, and credit spreads remain at ultra low levels. We're seeing the yield curve starting to steepen, which is a sign of recession. We're seeing cracks in the labor markets that we've been explaining in these presentations. We've had on the breadth of the market, if you look at cyclical industries that have been underperforming significantly, we've had numbers in terms of the consumer data showing deterioration. And mega caps are now, as Kevin was presenting, are starting to lead to the downside, which has been basically a market that lacked the real participation of other industries, and now we're seeing the actual leaders starting to fade in a significant way. And I would point out to what happened yesterday, or 2 days ago, which was the decline of the semiconductors industry. It was the worst day for the SMH or the SOX index that since the crash of 2020. It's always a good reminder that when you're coming up from record or near record valuations, fundamentally speaking, risk happens really fast. And now we have the Fed communicating rate cuts essentially, and people are seeing this as bullish when historically it has never been bullish, which is not shocking in terms of the fact that people and investors tend to have a short-term memory and forget about the trends historically, in which when the Fed starts to ease monetary conditions, it usually is on the back of a very negative environment for the economy. And then on top of it, you have, in my view, what is the most important things going on too is the behavior of the market. You have treasury liquidity drying up, and you have the dollar not really appreciating in this environment. Let's go to the next chart. So in this next chart, you're just looking at the yield curve and versus the corporate spread. So basically leading the way to the upside. And you can use the yield curve in a lot of ways. And we think that we're going to see much more steepening in this spread of the yield curve from short-term versus long-term. In other words, a lot of people try to get too hung up on if it's going to be a bear steepener or a bull steepener. We don't necessarily need to have a view on that. I actually think both sides of the trade look very attractive. The 2-year yield, as I said in the prior presentation last Friday, I do think that there's a case to be made for what used to be called the T-bills and chill, to be made in terms of the short-term yields being very attractive at these levels. And then on the long end, the flood of issuances and the problems with inflation staying entrenched, and the lack of discipline in the fiscal side, I think is very reflective of the risk on the long end of the curve in the treasury market. So that is the blue line, and then you're seeing the white line is risk being measured in the corporate bond side. And so when you see that line increasing, it means you're seeing stress in the markets. And so the same way VIX has been significantly low, spreads have always also followed the issues in the markets. And so I think that that's also another instrument that will show issues if this is really the beginning of a bigger problem, which I would certainly am of the view that that's the case. Let's go to the next chart. Next chart showing the volatility of the small caps that Kevin was referring to. We've had a kind of a broadening out that people were saying about the small caps. And I want to remind you of everybody that back in the 2000s era, when we had the technology bubble, what really peaked first was actually technology. Technology sort of started to fade. And then we had a broadening out of the market or other industries. If you look at equal weighted index for the S&P 500, it actually had another resurgence and caused the S&P 500 market cap weighted to retest the highs of the March 2000 in August of 2000. And that was the double top of the technology bubble. And then we peaked in decline. And this chart, you're looking at the volatility, the same VIX idea of the S&P. You're looking at VIX also for the small caps, and you can see the divergence between those two tend to happen as well, tend to precede big volatility events. So in my opinion, this is another way of sort of looking at a leading indicator for potentially seeing volatility picking up significantly. Let's go to the next chart. Here is a problem that certainly turned out to be an issue back in 2021, and today folks are saying that this time is different. Which is the inflows in large caps. You can see here throughout history, we don't tend to see this type of inflows coming into mega cap stocks and so forth, and technology companies to the degree that we've seen recently. And there is, we're pretty kind of far in that pendulum in terms of inflows of capital into this part of the market. And so it wouldn't be surprising if we see a shift away from this part of the market. Let's go to the next chart. Next chart is looking at the technology sector weight in the S&P 500, including Amazon, Google, and Meta. I think that's a fair way to be looking at this. It's over 40% of the index today. And actually, if you compare that with the tech bubble, we're substantially higher, 10 percentage points higher than we were back in the peak of the technology bubble. Also slightly higher than we were back in the 2021 peak as well. And, I think this is where you can measure how stretched things are. In my opinion, investors are sort of running out of ideas to justify these sort of distortions and historical distortions that we have in markets. And at some point, this is what creates or sets the stage for a reckoning moment. And so, this is why I find that the risk-rewarding idea of investing in technology just seems, it far exceeds the risk far exceeds the reward, in my opinion, or the potential reward, in my opinion. Let's go to the next chart. Next chart now is going to start something that, look, I'm in the process of writing a letter back in 2020. I remember, calling actually Kevin and the investment team here, Crescent, from an airport where I was reading on a flight about inflation in the past, and I end up, forming this really strong opinion about inflation, how inflation was likely to, we're probably going to see a resurgence of inflationary forces in the U.S. economy. I've got plenty of things wrong too, but these are sort of incredible moments in that change how assets behave and create this great opportunities. And that's really when it kind of really solidified this view about commodities and real assets. And then later on, I started to learn more about, back in early 2021, about the issues with issuances of treasuries, and which I think it's become much more of a known issue by market participants as of now. But back in those times, not a lot of people were really knew about that. In fact, I remember writing a piece on Twitter. Bill Ackman actually shared that piece and not too long ago, and to me, there's something else happening that could potentially be as big as those two changes in markets. Not only the resurgence of inflation, but also the upper movement in interest rates, and I think it's the depreciation of the dollar. I've been developing this conviction of that view. And it's predicated on the chart you're looking at. I think that's the single most important problem the U.S. economy is facing today is the federal debt net interest payment relative to GDP. And by the way, we're looking at net. So for those that like to be more conservative, that's the most conservative figure. You can see here there's centuries of data looking at this number. And the very final numbers are looking at the CBO, or the Congressional Budget Office, projections for 2034 of 4.1%, which tends to understate the problem, in my opinion. The CBO, as is well known, tends to really be very conservative in their projections. And this is a projection that also doesn't assume any recession in a decade, which I find it highly unlikely. And but notice another thing here. You can notice as well that 1940s time, the net interest payment relative to GDP was substantially lower, despite the fact that the debt problem was exactly the same as where it is today. And so, it gets to me. I start thinking about this. I mean, at what point do we see the Fed really stepping in and having it's a change of mandate from inflation and labor market stability to making sure that the government will pay its bills? And I think we're getting close to that. I think we're getting close to what used to be a long-term issue is becoming more urgent over time. It's transitioning to become more urgent. And it got me thinking as well about one thing that it really created this divergence of the U.S. markets in terms of growth relative to the rest of the world, which has to do with the fiscal dominance. The fiscal dominance of the U.S. is something really important. The fact that the U.S. has the reserve currency status allowed the U.S. to also run bigger deficits, run a much more aggressive fiscal agenda. And I think that that's unsustainable right now. Given this chart, I believe that there is a real risk for this fiscal dominance coming from the U.S. relative to other economies, which makes me think about if we've had aggressiveness from a fiscal side. The biggest thing that really translated from that is growth been a lot stronger than other parts of the world. But secondly, if you go to the next chart, you can see here that foreign allocators, or I should say holdings, allocators of foreign investors have been deploying a lot of capital in the U.S. So attracted capital to the U.S. because of that growth, that exceptional growth relative to the rest of the world, also attracted capital to come into the U.S., also making, if you go to the next chart, the U.S. markets a lot more frothy than other parts of the world. So you look at price to book, you can look at price to earnings, you can look at the performance of the U.S. markets relative to other places in the world, and you will see there's a big spread between the two, in which, in my view, if we do see this dominance shifting away, I think that that's going to also translate in a big change of these charts. And now the capital flows out of U.S. equities into other parts of the world. And that's why I think, the risk of investing in technology, U.S. equity markets, when you have all these other things that potentially look more attractive, and the potential also for the flows of coming out of, something that looks really stretched, in my view, it could be a very meaningful shift in the macro landscape. If we go to the next chart, another thing that is likely to cause is the change of the U.S. dollar. This depreciation of the dollar, to me, or the potential for that is probably one of the most important macro developments here. And you can see this if you look at the British pound has started to show that. And I'm going to show you 4 more charts that look exactly the same way, but this is just the beginning, in my opinion. I remember looking at, presenting this to our own investment team, looking at the 10-year yields, and I remember that there were some yields in the U.S. curve, long historical trends, and the same thing started to happen globally. So we had, the U.S. started to move first, and then you start to see the same thing happen in Europe. The same thing started to happen in places like Japan. And I think that that's sort of the same idea here. If we go to the next chart, you can see Canadian dollar actually also not yet bumping into that resistance or going above that. But look, it's starting to show like maybe there's a potential of a bottom. If we go to the next chart, you can see the Peruvian sol, or the Peruvian currency, also doing exactly the same thing. If we go to the next chart, you can see that the South African rand also doing the same thing. These are not unique developments. They're all in a way, connected, interconnected in a large way. And what is, to me, even more important, notice on days like today, in which the dollar should be shining, and it's not. The treasury market should be shining, and it's not. And on top of it, you have one of the most aggressive interest rate differentials of the Fed versus other places in the world, particularly Europe and other developed economies. And still, we're not seeing signs of constant appreciation of the dollar versus other currencies. In fact, most of these charts that I just showed you looks to me like the dollar, or I should say other currencies, are starting to form a bottom, a historical bottom relative to the dollar. And we should also point out that usually when we have foreign currencies really appreciating relative to the dollar, it creates two important things. One, we tend to see foreign markets perform better than U.S. markets. Now, that would be unthinkable in today's environment. I just showed you a chart of the price to book of the U.S. markets versus the MSCI world, excluding U.S. And I think that that's, really one way to see that. The second thing that it tends to happen as well during periods where foreign currencies outperform the dollar is that real assets tend to do very well. To me, this would be the type of change that could cause this next leg up in gold prices, next leg up in silver prices, the next leg up in copper prices. I think it needs to happen on the back of a very strong tailwind on the macro side. And I think that's what it is. That's in the next 2 to 3 years. If I would point out to a narrative that would be all, in all media, financial media, it will probably be about the dollar. And this is not coming from a political view. This is not coming from, the end of the dollar view or anything like that. It's just from a macro standpoint, it looks to me like the dollar is poised, and more is becoming more convincing that the dollar is likely to face a major depreciation relative to other currencies and also relative to real assets. The real assets portion, we've shared many of our views there, but I don't, for us, we've always had a very strong view about the dollar. This is a shift in our own views about how things are likely to play out here in the near future. Let's go to the next chart. I'll try to keep it short now. And the most important thing going on today as well, outside of all these things that I mentioned, is what's happening with mining stocks in the gold space versus gold. Gold is down close to over 2%, depending on the time of the day today. And mining stocks are not down as much. And I pay attention to those things because I think we're in the process as well of bottoming in this chart. And in my view, I think this will surprise a lot of investors because the skepticism tends to morph into opportunity, and this is a classic type of opportunity where you see a bunch of investors with one view, and then when they change their opinions, it usually translates into a change in market pricing and also a repricing of valuations in this industry that I think it's way overdue for having its day. And so I think that that's the case. And when I look at this chart, I am just tired of seeing lazy research of people saying, the main reason, Tavi, this doesn't outperform is because there's too much dilution. Mining companies, they don't make any money. Look, let's do a step up of research. Let's go to the next chart. why in the world, if that's the case, why in the world are copper miners outperforming copper? That's such an important question. Are you not seeing dilution in the copper industry? And copper, Quinton can maybe talk about this, but to build a mine in the copper space, it requires a lot of capital, perhaps even more than a gold project. I don't think that has anything to do with that. I think that the green revolution has attracted capital to copper that is now spreading into other things like copper miners. But even if you go to the next, well, this chart just showing the consistency of copper miners relative to copper since the pandemic. And some people will say, zoom out. You can zoom out and you will see that there are other times that the copper miners have not outperformed copper. But recently, different than gold, we had this industry, in my view, showing the way for what is likely to happen with the gold space. But if you go to the next chart, why we're going to see that? Well, this is an interesting chart. If you break down into operating margins of commodity producers, you will find that, yes, oil companies are basically have become true free cash flow machines, which, by the way, 5 years ago, that was unthinkable. Nobody thought oil companies could make any money. And now they're one of the most profitable part of the commodity space. And that's just predicated also on oil prices relative to how much it costs to produce, obviously. And the same thing, in my view, will happen with other industries. And even from that perspective, if you look at a gold company versus a copper company here, slightly better margins, right? You can see there, slightly better margins. We're looking at a median of most of the major companies that have over $1 billion in the Canadian and US exchange. And you can see here that even from that perspective, actually gold miners are slightly more profitable than copper miners. And so that doesn't really explain the fact that they have been underperforming. Now, after further questions, maybe this has to do a little bit with the reserves quality of those two industries. Still, I'm of the view that ultimately capital that is flocking into the gold space will also, speculation is driven into the other sides of the industry, and ultimately that should drive the prices of the miners significantly higher relative to gold as well, and become more of a lever play in gold itself. And so, I'm almost marking down the names of the people that don't think that's possible, because I think that will be a view. I've said this before. I think it's one of the most historically unsupported views that I've seen in my career. Because we've never seen this before. As we saw in the 70s and early 2000s and so forth, we tend to see the mining companies really lead the way to the upside. And I believe this will happen again.